today, folks, and that's right, I'm back at it again. We're talking about Steve Eisman, but more important, his partner in crime for shorting the 2008 financial crisis, making billions of dollars, of course, Michael Burry. We're going to be reviewing his portfolio, but as many of you might recall, over the last couple weeks, I've been making a lot of fun of Steve Eisman for making comments just like this.
It's important here because I don't think they're particularly interesting either. I don't think they're interesting, and I don't think they're important.
He has been just harping on the entire financial sector, which over the last few weeks has been one of the top 3 best performing sectors, even outpacing tech stocks, which is just mind-blowing to me. But what makes this even more mind-blowing is his partner in crime, the likes of Michael Burry, have been taking the adverse opinion. He has currently 39% of his entire portfolio in the finance sector, and I was really glad this kind of got brought to my attention from our chat group. One of you brought this up about the stocks he was holding, and I decided to deep dive into them, which if you want to join that chat group, talk 24/7, 7 days a week, consider supporting me on Patreon to get that link. But nonetheless, we're going to break down some of his top holdings, I think 6 of his top stocks, talk about what's going on with the finance stocks that he holds here. We'll talk a little bit about the technology sector because it's not the tech he's holding that you'd think. A lot of China stocks, a lot going on there. His third biggest holding sector is consumer discretionary. And just getting into this, if that is a conversation you'd appreciate, as always, consider hitting that like button, folks, because coming in at numero uno, the largest position he currently holds out over 10% of his entire portfolio is the New York Community Bank Corp. Of all the banks you could have picked, why would you go with one of the regionals, like one of these smaller cap, more volatile banks? I mean, JP Morgan's great. He did buy Wells Fargo, but it is a much smaller position. We'll see later on in this video, but this one's down like 20%, give or take. It has been rallying off the lows, trading for around 9.9 billion. But what blew my mind was the earnings of this company, because as mentioned, in a higher interest rate environment, my bull thesis is that inevitably when we get through the shaky market, the bad loans get shaked out. They're done putting loan loss provisions aside, and if interest rates stay way higher than even where they were, I mean, they're going to make record income just off that alone. And that's kind of what we're seeing, because their net interest income sits at around 900 million versus 55 million this time last year, which was a 62% increase. But they saw a negative 86% decline from their non-interest income. This bank got absolutely wrecked, going from 2.09 billion to 302 million on all their other income. Net income, total revenue, was 1.2 billion dollars, and that is a 55% decrease. What is the value he sees in this bank? Of all the banks, I'm really not quite sure, but putting that aside, we should talk about some of these Chinese stocks. Now, his 2 next biggest holdings, making up well over 15% of his portfolio, is JD.com and of course Alibaba stock. Now, these companies have been resilient if they're not lying about the numbers, because I mean, you look at the total revenue on JD and it is literally over doubled, or pretty much doubled, just in the last few years. From a balance sheet perspective, I think they've got over $50 billion in cash minus their liabilities. I mean, they're in a fabulously strong position, beating pretty much every analyst expectation over the last few quarters. But Baba, I think, and JD, they have this kind of slew, this black cloud that's been following them around ever since China cracked down on them. You know, they got rid of the CEO. The guy basically disappeared. We've never really heard from him again. Alibaba's never really been able to recover from that crazy tech blow that China did. I mean, there's this fun little article here that kind of highlights what China's trying to do to correct this, because China's tech crackdown cost over $1 trillion. The market cap wipeouts were insane, but the economy is in such deep trouble that the country's cozying up to its tech firms again. Now, people aren't really fixated on China's economy as much because these tech companies are still able to post such record revenue numbers. And the thing that always concerns me is, like, you really need to be on the ground floor and understand what's going on with this, because, you know, basically the authorities are laying out the red carpet at this point. They're so like, oh my God, we did something so stupid here. Local governments in China are wooing their tech giants with, at least they're not trying to woo the tech giants, they're trying to woo investors. At least 5 recent deals to build on the so-called platform economy. The South China Morning Post reported on Sunday that Beijing's based Qhu 360 recently signed an agreement with the government of, I'm not sure exactly how to pronounce that, but that's the home to Alibaba, to boost cybersecurity, according to a local government notice on Friday. They've been signing deals with some of the gaming companies, which you might recall, they went after gaming companies to control how much kids under, I think, the age of 18 or something could actually spend on time playing games. Like, they just went on a rampage during the worst possible time in the economy with these big tech giants. And now people are so hesitant in the Western world to invest in them, they're having a hell of a time trying to bring that money back. And I don't know if that money ever comes back. You know, Michael Burry, as mentioned, and we'll talk about things like GEO Group, the prison stocks, because because I used to own them, which he's been actually selling out of them this year. But those are the kind of stocks that just because they're cheap, just because they're discounted, doesn't mean the stock is going to rally. You need investor focused attention and investor money and hedge funds. Those people need to be like, I want this in my portfolio to see a substantial gain on an undervalued company. And that's not going to happen with the prison sector. I'm sorry. You're never going to see substantial gains. But I think that's something that is a hurdle that is one of the biggest hurdles to get over when it comes to these Chinese stocks. Now, there were some brief discussions about it because other fund managers are picking up on the valuations here. And they're like, hey, I'll take a stab at it. Take a listen to the CNBC.
So one of the tech names I bought recently was Alibaba. Alibaba is sort of like a two-pronged story because she has no choice but to further stimulate the economy. You can have major unrest with the youth unemployment there. That's what kills a lot of economies, a lot of countries, a lot of ruling classes, as we saw with the Arab Spring, right? Mostly young people. So I don't think that's an immediate concern, but an immediate concern is that the economy is stagnating. You've got this inflation. So he came out last week and he said, look, here's what we're doing. It's hands off for the tech companies now. We want them to blossom. So he's trying to draw capital in. Now, Alibaba is sort of unique because they're going to spin off their cloud business. They're going to spin off their bricks and mortar retail business. They may, Ant may be spun off, may not. They announced they're going to keep their stock. So to me, this is one of the cheaper stocks out there. So whether you buy Baba or whether you buy one of the other like Baidu or others, I think it's a good place to be for that with minimum downside. So Baba.
I do agree. I think a lot of the Chinese stocks have finally found their bottom. However, a lot of these companies do spin-offs, which people don't really understand why they want to sell off a bunch of their underlying businesses. And that's to basically add separate equity value, because typically these individual businesses, kind of like talking about Apple's, AirPods alone, like that business generates billions of dollars. It could be on the S&P. They spun it off, made it a separate company. So when they spin it off to make another public company, they keep a huge equity share in it, and they can actually put that onto Alibaba's balance sheet and hope that the market sees that as a crazy valued player and it'll actually go up more and get recognized on its own, right? So that's why they try to do all these spin-offs. I mean, we're even seeing it with a lot of the companies. I think Johnson & Johnson is trying to do a lot of that right now. So that's the game plan that they're going against. Like I said, I think they've definitely found a bottom here because, again, they've just been beaten up so hard. It's just a matter of, can they really rally back to the highs like the U.S. tech companies are right now, hitting all-time highs? Because if they could, I mean, you're talking about substantial value if you want to take on that kind of risk in your portfolio. In that broad view of what he's holding here, if we just zoom out, we can kind of see some of the trades, the buys, the sells, and we can see for Q1, these are the stocks that he's been basically adding here. So you got the New York Community Bank Corp. We've discussed JD, Alibaba, Signet Jeweler, Capital One Financial Corp, Zoom Technology, Cigna Group, Liberty Latin America Class C, Western Alliance Bank Corp, and then the Sabina, what is that? How do you pronounce that? Stillwater Limited ADR. This is kind of like a gold mining company, right? Very intriguing picks here considering his average buy price. I love the way they show you how much he's up and down on some of these positions overall. But nonetheless, I think some of the most intriguing are the things that he's obviously sold over time. If we scroll down, I like that he also added Wells Fargo. I think that was a good buy. Picking up some oil and gas, following some of the Warren Buffett here. He did sell down 62.4% of his shares in GEO Group, which I mentioned. GEO Group is just a terrible stock from a perspective thing on the economy. Prisons are cheap. I thought they were incredible. I bought them. I got on Netflix because I talked about it. Made me look horrible. And he didn't make a whole lot of money on that one. All in all, I think Michael Burry can be more compared to the likes of Jeremy from Financial Education. He's more of a day trader, a swing trader. He holds stocks for maybe 1 to 3 years at the most, if that. And the likelihood of you making money over a long period of time, I think with a guy like this is very minimal at this point. It's almost like listening to Steve Eisman take the adverse opinion and be horribly wrong. Both these guys can completely prove to be wrong. I just did a live stream, go watch it, from Friday, where I just talk about guys like the easiest way to make money is just buying those solid foundational names that have been around for a very long time, have a very long track record. You might pay a premium for them, but just cost average into them. Pick up broad-based ETFs, and the whole point is to just never sell. That is how you get those long-term Warren Buffett-like returns. But as always, I'll pass the question off to you. I'd love to know what you think about this in that comment section below.